I'm named after perhaps the most famous engine of all time, aren't I? This guy. And no, I'm not talking about the new CGI remake nonsense. I'm talking about the OG original Thomas. Back when it was narrated by that guy who wasn't even the best drummer in his own band. Sorry, Ringo fans. But if you've been watching a lot of finance YouTube, you've probably come across a different kind of engine. InvestEngine. But seeing as you probably never even heard of them as recently as last year, I think there's some questions we ought to be asking before considering piling all our investments in with them. Who are they? Why is everyone talking about them? How do they make their money? Are they safe? Will they be here in the long run? And ultimately, did he ever get with Emily? Oh no, sorry, that's Thomas again. And ultimately, can you trust InvestEngine? Pretty big questions that require some pretty big answers. So who's going to answer them? Well, cue special guest. Nope, budget wouldn't stretch, I'm afraid. Just me with some pretend glasses on. No special guests here. Let me start by saying that I am in no way sponsored by InvestEngine or any of their competitors for that matter on this channel, so I am free to say what I like. You won't even find an affiliate link to InvestEngine in the description below. My mission here is simply an honest review, no ulterior motive whatsoever. Let's start with who they are. Well, shovels out and a bit of digging around on Companies House will show you that InvestEngine UK Limited were first incorporated in October 2016, about 5.5 years ago. But by who? Do you remember back in the day, if you ever wanted to buy a dusty old lawnmower or sell your old mini discs, a bit of Googling around might have found you here, Gumtree. Well, Gumtree was the love child of this guy, Simon Crookall, who, according to this clip, can often be seen wandering around London playing what can only be described as the worst game of charades ever.
3 words. Exchange Traded Fund.
Don't know that film. Gumtree was eventually sold to eBay for a lot of cash. So, long story short, he's got credentials. But creating a place where people can meet and discuss passing on their old stained mattresses hardly means you know much about the investing platform market. Well, he's done what most good business people do and surrounded himself with a team of smart people, recruiting from ex-HSBC, L&G, BlackRock, Investec, to name a few. But that's not the full story, because there is this other guy as co-founder, Andrei Dobrinin, and my shovels struggled to find out too much juicy gossip about him, but I did find this. No, not his Tinder page. This is his LinkedIn. Does anybody still use LinkedIn? Not me. Looking at his CV, it appears he knows a thing or two about fintech. And look who I found lurking in his recommendations, Mr. Simon Crookall. They previously worked together back in 2013 at a company called Slando, which appears to be some kind of classified ads thing. But if they are the new kids on the block, can they really hang tough with the big boys? If you know, you know. Why do they appear to be topping many financial influencers' lists on top places to invest this year? A cynic might say it's the rather generous affiliate scheme that InvestEngine have been dangling around the creator space in order to get their name out there. They've been in touch with me too. But actually, there has to be a good service to back this up, because the creators that I know and that are in my circle of trust genuinely only want to promote products and services to their audience that they really believe in. So what is the attraction? Well, it's one thing, plain and simple: fees, or lack of them. If you decide to choose your own exchange-traded funds, or ETFs for short, you will pay no other fees other than the ETF management fees themselves. You see, that's what this is. It's a platform for investing only in ETFs, nothing else. So much so, it's actually their strapline. See, the ETF investment platform. It's as close to free as you can get, and who doesn't love free? But we aren't stupid, right? We all know there's no such thing as a free lunch. So it would be fair to ask the question, well, how the hell does this work? Businesses need to make profit to survive. Something doesn't add up. Well, there is another service that they offer, their managed portfolio service, that costs 0.25% a year if you choose this route. Basically, some ready-made portfolios that they will manage for you if you don't want to choose the investments yourself. So is it here that's picking up the slack? Is this the place that sees them make their millions? Time to get the shovel out once more, because the answer will lie in here, the company accounts. In 2020, they lost over 1.2 million, And last year, that increased to a loss of over £2 million. They're losing money, a lot of it, and it's getting worse. But before we all panic, for a relatively new fintech-style company like InvestEngine, this is not at all unusual. Last time I checked, Uber have still yet to turn a profit. It's clear to me that the strategy is to grab market share at whatever the cost. But the thing is that will need to change in the future, and they will need to find ways to make money and profit. Undercutting everyone else and losing money each year faster than Thomas loses steam over Emily cannot be a forever strategy. So if the strategy will have to change in the future, how? What might change is the next logical question. Well, I think they definitely hope that more people will spill over into the managed fund offering, thereby increasing the amount of people paying that 0.25% a year. I mean, I think that's fairly obvious. Supermarkets prefer you shopping in the especially for you range and staying clear of the yellow whoop sticker aisle, don't they? I guess they may even look to raise that fee if it becomes more popular. It's not that expensive, to be honest with you. 0.25% a year for a managed portfolio is pretty competitive in the marketplace in general, depending of course on how good those portfolios are, something we'll come on to in a moment. But I think a more likely direction of travel is a premium feature-based model, a bit like free trade, where some extra features and benefits get tucked away behind a paywall at some point in the future. But I'm only guessing, what the hell do I know? I'm just a triple TE fan guy at heart. Thomas the Tank Engine. That's what the superfans call it. However, what I do know is this. They are not in this to lose money year on year like they are currently. Look at this, they've just concluded a rather successful crowdfunding campaign whereby they wanted to raise $700,000, but they actually raised over £1.5 million, more than double what they wanted to achieve. Now, despite the obvious fundraising similarities between them and free trade, it's clear this is evidence that they are making some waves and getting people to sit up and take notice. And with over 30 million in client assets spread over 6,000 or so clients, they've certainly made a start in penetrating the market. It is just that though, just a start, because these numbers in platform terms are not very big at all. But let's not do what everyone did at school against me, let's not hold size against them, because there's only really one important question here, isn't there? Is the service actually any good? Well, let's start with their own marketing message and then delve a little further. As mentioned before, they market themselves as the ETF investment platform, boasting unbeatable value, a choice of 500 plus ETFs, actionable insights, whatever the hell that means, powerful automation, easy diversification, DIY or managed. So let's be clear, all that stuff is really good, but let's be frank, a lot of that is not new. So why does it appear to be so popular? It comes back to the yellow whoop sticker. It's the fees. The thing is, for most investors that are happy to choose their own investments, they're looking for three main things. A tax-efficient wrapper like an ISA, a good range of investments to choose from, and low costs. And InvestEngine ticks all of those boxes. No wonder there's no affiliate link, Tom, comparing them to the yellow whoop stickers. They're cheap, it's a compliment, that's what I'm trying to say. One thing that many people will place firmly in the negative column is the fact that you can't buy individual shares on this platform. So if that's what you're looking to do, then they ain't for you. And given their ETF-heavy advertising message and mission statement, I simply don't see that being an option in the future unless they have a serious U-turn in strategy. In a lot of ways, although this will put some people off, having a targeted strategy like this, focusing on just ETFs, helps them differentiate from the crowd and might help them do rather well. Jack of all trades, master of none and all that. But let's go beyond their own marketing spin and get our shovels back out to go a bit further. Most platforms fall into one of two camps. DIY investing, i.e. choose the investments yourself, or managed portfolios, let them choose for you. So it's interesting that InvestEngine are trying to cover both bases. Remember, DIY investing is free and the managed portfolios cost 0.25% a year. But are they worth that cost? Now, I don't want to get into the weeds with this, so I'll cover this as concisely and quickly as I can. The portfolios are split into growth and income portfolios across different levels of risk. There are 10 growth portfolios and 3 income portfolios. The first real challenge in reviewing these portfolios is that they haven't been around long enough for us to have a look at any past performance data. However, you can have a look at the underlying ETFs inside each portfolio and see how well they've done. The problem is, that doesn't really give you a flavour for what added value, if any, the InvestEngine managed service actually provides as they make tweaks and changes to the portfolios into the future, so only time will tell on that. Okay, I said we wouldn't get in the weeds with this, but just very quickly, here's the asset allocation for the middle growth portfolio. About 65% in stocks and shares, 30% in bonds and 5% in commodities. So if you wanted to compare that to a similar basket of passive style investments, how about the Lifestrategy 60% fund offered by Vanguard? That wouldn't be a bad comparator. However, interestingly, the geography allocations are pretty different. With the InvestEngine portfolio, it's pretty heavily weighted to the US with around 60%, whereas the Vanguard equivalent we discussed earlier is more like 30%. Now, I'm not trying to draw any conclusions there on which is better or worse, depends what you prefer. But what I would say is if you're considering the InvestEngine managed funds, take a look at the underlying asset allocations. I'll leave a link in the description below. The income portfolios are interesting, as the title suggests they focus on providing a regular income to investors rather than focusing on growing the portfolio value. They seem to focus on holding bonds more than the alternative strategy of dividend-paying companies, which in theory should lower the volatility too. They estimate their cautious income portfolio will produce 1.6% a year in regular income, their higher income portfolio 3% a year, and finally their enhanced income portfolio 3.8% a year estimate. With inflation through the roof, truth is this isn't helping you a great deal, but if achieved is still better than cash in the bank. But that's just it, if it's achieved. These are only estimates and we've got no track record to go on. Now, for any one of their portfolios, they will suggest one to you after completing an attitude to risk questionnaire, which is pretty standard industry stuff, to be honest with you. I have heard mixed things about this questionnaire, the main criticism being that it's jam-packed full of industry jargon which can quite easily bamboozle a beginner, and unfortunately it is often this way. The question is, how do they choose these ETFs that go into the portfolios? Because in here lies the potential value that this service brings. Well, luckily for us, that exact question has been answered on their website. Having chosen the asset class, region or market segment we want exposure to, we will then select the most liquid ETFs in each category. This means ETFs with high trading volumes, low bid-offer spreads and minimal tracking error. We also pick ETFs with low total expense ratios and only invest in physical ETFs, which either replicate the index they are tracking in full or sample a proportion of it. So there's a formula. They decide they want 60% in the US, for example, and they choose the cheapest ETF that represents that market as best as it can, that is traded regularly, which for passive investing makes complete sense. The truth is, if you're looking for this managed style, there are companies out there that have been around for much longer and have more of a track record. I mean, the Vanguard Lifestrategy fund range are a great example of this. I could bring up some other niggles. Look, there's no pension wrapper. The £100 minimum, albeit relatively small, is not the most accessible in the marketplace. They've got ethical funds, but no ethical portfolios. And there's no practice account option, which I really like to see for beginners. I think it's great that they offer a business option so companies can invest money, but I think more people would prefer a pension. InvestEngine could be onto something. They've gone for the penetration model, come in cheaper than everyone else, get traction, get customers, and then scale up and monetize once they're in. They need to find a way of making money if they're going to survive and be around for you as the investor in the long run. And that way of making money has to be accepted by you as the investor in a very competitive marketplace. So I think they face a very interesting few years ahead of them as we get more and more portfolio data and track record, which will naturally come under more and more scrutiny. But look, there's no exit fee, so you can leave in the future if you're not happy, and your money is protected in all the usual regulatory ways that you've come to expect through any decent platform. So coming back to that original question, can you trust InvestEngine? I see no reason not to. No more or less so than Thomas sniffing around Emily's rear bumper anyway. The dirty dog. Do you want to know what's really funny about that analogy? Do you want to know what my wife is called? Yep, you guessed it. Sometimes these scripts just write themselves. This is the next video to watch, which is all about how between me and the dinosaurs at Vanguard we almost made a right mess of my investment ISA. Hopefully if you watch that you will avoid falling into the same trap that I did. So I'll just leave that there for you. Just there. Just click it. Go on, click it.